Last week I was visiting Oslo, the capital of Norway. So I thought this week it's gonna be appropriate if we go over the biggest Norwegian company, and that's Equinor, which I believe is a energy company. So they work with petroleum. Let's take a look at their description. So engage in exploration, production, transportation, refinement, and marketing of petroleum. And they have been around since 1972 in Norway. And I believe they are mostly owned by the Norwegian government. Something like 70% of it is owned by the Norwegian government, and the rest is owned by some big institution and the public. But without further ado, let's get into this. Hello and welcome to this video. So let's get us started with this energy company and let's see how does it hold up as a wonderful company. So let's first take a look at the revenue. So the revenue was mostly flat in the past years, but recently it went up, and it can be because of the price of petroleum. So this is something that we need to check to make sure, are they selling more stuff or is it just the price? Because this company is probably selling a commodity. So the price of that commodity is gonna have a big effect on its revenue. And we need to check that to make sure if the revenue went up because of the price of that commodity or is this something else. So the revenue is a check. We will check that later on if we decide to move forward with this company. Let's take a look at the equity. So the equity was pretty good. It was going up all these years and it was a stable. So this is what we are looking for, a stable growth, and let's see how much was the growth. So 86 billion to 531 billion. That's like 6 times higher in 20 years. That's something like maybe 8% increase. That's good, that's not bad. But let's take a look at the quality of the equity. We can go here and over here we can see that who the owners are. So it's something like 70% of it is closely held. That's probably the Norwegian government, and the rest 30% are float shares. And you have more information here if you want to go through. But let's take a look at the equity, what we are here for. So let's see, the equity right now is 1.6 billion assets and almost 1 billion in liabilities. So let's take a look at liabilities and assets. So it seems that the quick ratio is good. So it seems that they have more current assets than current liabilities. That's good. They don't need to go into more debt to finance their short-term operations. And their debt is something like 300 billion. Let's open their current assets a little bit. So their current asset is mostly cash, and we love that. We love to see a company have lots of cash. And we can open that, and it's 200 billion cash or cash equivalent and 300 something billion short-term investment. This is really good. I like this because they can pay all their debt using their cash. So 500 billion, and then they have 300 billion in debt. Their net debt is minus 200 billion. This is really good. So they have a strong cash position. Something like a third of their assets are in cash, which I love. I love the company to be able to spend that cash, but if they can't, I love them to have a strong cash position so they can use it whenever it's needed. The inventory is not that high, which is good. The receivable is not very worrisome, so that's good. Let's take a look at non-current assets. So the non-current assets is mostly in property and plants. That makes sense. This is a petroleum company, so probably they have lots of oil refinery and these sort of things. So it makes sense for them to have lots of plants, equipment, properties. And as long as this number is not going higher and higher and higher, it means that they don't need to reinvest in properties and plants and these sort of things to keep the business running. One thing that we can take a look here now is the capital expenditure. So how much is the capital expenditure compared to cash from operation? So cash from operation was something like 100 a couple of years back, then it went up, and right now it's something like 300. Let's take a look at capital expenditure. So this is not good. All the cash that they make from operation is going into capital expenditure in the past years. Right now, it's a little bit because the cash from operation is higher, the capital expenditure is not that high. It's something like maybe 25%. 25% is still not very low. We like it to be something like maybe 10%, but it's better than before. But the problem is if the cash from operations goes down, for example, the price of oil goes down, then this company can get into trouble. They won't have any kind of free cash flow. So that's a little bit worrisome. Let's take a look here. So they had a free cash flow of something like 20 billion, minus 20 billion, 20 billion, 70 billion, 30 billion. And they were paying dividend of 15 billion, 12 billion, 21 billion. So it seems that they are paying lots of dividends. And recently it has gone way higher without having any kind of good free cash flow. That's a little bit worrisome. So we need to make sure that won't put pressure on the business. So let's see if they had cash before too. So before the cash was a little bit lower, not 30% of their assets, something like maybe 15%, 10% of their assets, because they sold a lot of stuff recently from 300, 400 billion to 1.4 trillion. Probably that's why they have lots of cash. And let's take a look. So here we want this operation to be 25% of revenues. We call this operation margin. So we want the operation margin to be something like 25%. Previously in 2016 it wasn't, in 2017 it was 20%. Actually we can go to statistics and see the numbers here. So operation margin 3%, 20%, 25, 15, 9, 35. So it seems that it's not very stable, and that makes sense because this is a commodity company, and I don't like commodity companies because there are some external things affecting the business, and I don't like that. I want the business to be very predictable, not being affected by outside sources. And we can see the return on asset. They have lots of assets, but the return was not that high. I want it to be something like, like here, this last year, 20%, but it wasn't the case the years before. So this is a little bit worrisome. They are just selling us more stuff because the price of oil is higher than before, maybe. So we need to dig deeper on that. And just here, let's go and take a look at analysis of their future. So let's see. The future estimate of their earning is gonna go down. So people think their earning will go down, and that makes sense. They were like this 17 Norwegian kroner before, and they went up to something like 70, and it's gonna go down. And the same thing for their revenue. So they sold a lot of stuff, but it's gonna go down, and we don't like to see that. We would like to see the company to go higher, but this is future estimation by some people. Maybe we don't agree with them, so we don't look at their forecast, but that's something to dig deeper on. So let's move on to the next one. The asset has been going up and up. That's good. And the quality of assets were good too. So this is good. The return on invested capital, as I said, it was going down. So previously it was 20% and it went down and down, and now it's higher. So we need to know why is it higher. Is it good investment, good management that was able to turn this company around, or was it higher sales and higher oil prices? So let's take a look at here. So earning before income tax, it was around 150 billion, but right now it's 700 billion. So they don't have very stable income either. So like their revenue, it goes up and down. And let's take a look at the margins. So the margin is something like 2%. So different years, it's something like 10% to minus 6%, and the average is around 2%. We don't like that. We like the company to have high margins because if they have high margins, if something goes wrong, they can weather the storms. They won't go bankrupt. This company probably won't go bankrupt because they have lots of cash and they're oil business, so probably government has their back too. But if they get into trouble, they won't make that much money. And it seems that, yeah, they haven't been making that much income either. So something like 40 billion using something like 300 billion in equity, or something like, if we look at their assets, out of 1.2 trillion of asset, they're making 40 billion in income. That's very low margin. We don't like low margin. We want high margin. And let's take a look at their free cash flow margin. So their free cash flow margin is something less than 10 all the years, except the past 2 years. And that's not good. We like this to be something like 20, 25. Their debt wasn't that bad. We know that. But let's take a look at their interest expense. So interest expense was around 9 billion last year. Let's take a look at the operation income. So the income they have from operation each quarter was around more than 100 billion, and their interest expense is negligible comparing to that. So that's okay. Let's take a look at their dividend payout ratio. So it seems that they have a high dividend ratio. As you can see, something like 74% is the average they have been paying out, some years even higher, and we don't like that, because if it works like that, they can't sustain the dividend. The dividend has been going higher and higher, and it seems that in COVID year they paid not so much dividend, but they went back up. But it seems that it's not sustainable because they don't have that much free cash flow. Free cash flow is around maybe 30 billion per year, maybe some years even less, and the earning is around 30-40 billion. So they can't pay that much dividend. They have been paying yearly around, some years more, some years less, in dividend. Let's take a look at the shares outstanding. Let's see if they have been diluting their shareholders. So a couple of years back they did that. So they diluted their shareholders by 50%, but after that it wasn't that much. So it seems that they haven't been diluting their shareholders in the past 17 years. So that's not that bad. But overall, the fact that they don't have a very stable income, so we are gonna remove this company and move on to the next opportunity. Thank you so much for watching this video. Please like and share the video with your friends. Subscribe to the channel, tap the bell button to get notification whenever I post a video so you won't miss it. Comment below if you have any questions. Enjoy the rest of your day and see you on the next one.